Okay, I think we can make a start. So hello, thank you for joining us for today's Monitor Explained webinar, where we'll be taking a deep dive into the second issue of our Monitor Report 2025, which is our quarterly report that gives you an up-to-date view of the current non-energy costs. But first, a few webinar housekeeping words. So this session is being recorded, so it can be shared with you after, and for anyone who couldn't join us live to watch on demand. If you have any question, please submit it in the Q&A function throughout, and at the end of the presentation, there will be allocated time where I run through these questions with the experts. If any of your question cannot be answered today, we can take them away after the session. So if you are a customer and you haven't got a copy of the Monitor report just yet, you can contact your account manager for a copy or access it by logging in or signing up to EDF's Market Insight portal. The address is showing on the screen right now. So Market Insight Portal is your gateway to regular updates, and it's there to help you make informed decisions for your business and have access to quality data and expert analysis to help you navigate a complex commodity market. I am Charlotte Simon, Senior Account Manager at EDF, and I'll be hosting this session today. Joining me are technical experts from the Wholesale Market Services team, David Edmond, the Head of Pricing and Valuations, Hugh Boyle and Dan Menifee, Lead Analysts from the Pricing and Valuations team. So David, perhaps you could start with a quick overview of what we're going to be talking about today.
Yeah, thanks, Charlotte. Hello, everyone. So we'll do a normal sort of agenda that's hopefully become familiar to people that attend these regularly now. We'll start off with, I'll give a quick overview of going through all the different non-energy costs, looking at April 25 in particular to support with budgeting for customers. Hugh will then take us through a deep dive into some of the big tenures increases we're expecting to see off the back of some information that the National Energy System Operator shared at the end of April. And then Dan will take us through updates on the capacity market costs from auctions that we saw in March on those since the previous report. We should then have plenty of time for questions at the end. So yeah, please do send them in as we go, and we'll pick up any that are relevant if we see them as well as we go through the presentation. So to start with, I'll give an overall update across the main non-energy costs that we see. So if we start, work through this table line by line and look at Basuos, key thing that has changed here since last time is we've decreased our high rate view by quite a bit. The reason for that is we think there's now very little risk of the rate being reopened in summer 2025, which will end at the end of September. We have been seeing warnings from NESO that they think there could be high costs, and they're particularly flagging there could be some transmission network constraints throughout the summer. But so far, off the back of quite a large over-recovery across the winter, they've then continued that over-recovery against what they were expecting at the start of this summer. So about £90 million they over-recovered in the winter, and another 70 million on top of that this summer. That means they've got pretty healthy cash reserves compared to what they're expecting, so that if they do see those high costs come through, they should be able to fund that in the short term through the money that they've got and the money that they're already expecting to collect from suppliers, rather than needing to open up the rates. Just as a reminder on that, since April 23, the rates for Basuos are fixed in advance by NESO, but they do have the right to open them up if they need to collect some extra money if the costs actually outturn higher than they're expecting to by a significant amount. In terms of the best view to use for that, we've put the low rate in there. That reflects the published rates by NESO that they have, in theory, fixed the rates at. A high rate is because there is still a risk for the winter that if we do see high costs from now over the rest of the year, there is still a possibility that we could see high enough costs that NESO need to increase that rate. Moving down to CFD, the Contract for Difference scheme. This is always quite a wide range because of the high dependency on wholesale prices. We've narrowed it since the previous view, and that's because we've now got some outturned data, and also there's less time for wholesale prices to change as we go across the year. Because the contract for difference works as a top up to market prices to a fixed strike price, the lower market prices are, the higher the rate can be. And if market prices increase, that this cost will drop correspondingly. So because of that, the best view to use as a central view is closer to the high rate. That's because market prices could rise by a lot more than they could fall by. If they rise by a lot, we could move towards the low rate because they can't fall by a huge amount because there's more of a natural floor to where the prices will be generally. We don't expect there to be huge decreases in the wholesale price relative to where forward prices are at the moment that is informing our forecast. So something closer to the high rate is the best view of where that's likely to continue to outturn across this year. The capacity market is the next one. So as I mentioned earlier, we'll go into this in a bit more detail. The key thing to note here is this range has narrowed significantly off the back of having the T-1 auction in March. So we now have a lot more certainty over what that cost will be. There are still a few things that could change around things like chargeable demand in the 4 till 7 p.m. November to February working day periods. So that's why there is some range of what the actual rate of charge could be. But generally speaking, somewhere close to the middle of that range is a good assumption and shouldn't be too far off what we ultimately end up seeing when that's all outturned. Distribution charges, or DUOS, so they were confirmed quite a long time ago for April 25. They're published in December 2023, so we already know what those are and those aren't changing. So move swiftly on to FIT, or the feed-in tariff cost. So this one, again, is a similar story to some of the CFD and capacity market of a narrowing range, but still uncertain of where it will outturn, particularly depending on renewable generation. So often solar levels can play quite a key role in determining the level of this cost. The sunnier it is, the more payments there are to make to those generators. But we don't yet know how sunny it will be across this year, and therefore there's uncertainty over how big that cost will be. So that's one to keep an eye on. Again, middle of the range is the best view, but depending on the prevailing weather conditions, could move towards the high or the low as we go through the charging year. The renewable obligation is the next one, the RO scheme. So that was confirmed when we knew inflation for the 2024 year in February of this year. So that's been a rate that's been confirmed since then. There is the remote possibility of mutualisation costs coming through, but we don't expect that to be a factor from changes that Ofgem introduced to make suppliers ring-fence funds to ensure that they can pay that bill when the bill becomes due at the end of the year. So we are therefore not showing a low or high range against that level because we're pretty confident that that's unlikely to happen unless we see something quite dramatic, which we're not expecting at this point. TNUoS, so for April 25, TNUoS or transmission charges, again, similar to the distribution ones, are known. They were confirmed at the end of January 2025. However, there is a lot of interest going on looking further ahead with TNUoS charges for April 2026. So Hugh will cover that in more detail, but this is one that we have seen big increases that we were warning about a few months ago now start to be confirmed by NESO from April 26 onwards, looking further ahead. Then finally, the two newer costs that we've talked about before, the EII support levy, energy intensive industry support levy. So this is to fund compensating energy intensive industries for 60% of their network charges. We are starting to see invoice data come through for that for the previous charging year, which is giving us a bit more confidence over the level of charges that we're seeing come through there. And then because network charges from April 2024 to April 2025 are broadly flat, we expect that to be a similar level of charge that comes through for the April 2025 year, so somewhere in the middle of that range again. And then finally, the nuclear regulated asset base, or RAB cost. So this is to fund new nuclear generation while in construction as well as in operation. Still a lot of uncertainty over this one. We've not heard any new news in the last few months over this. At some point, we are expecting there to be a final investment decision on Sizewell C that would trigger the start of this cost, we believe, within 30 days of that decision being made. But until we actually see that decision being taken, it's very uncertain of when this will come in as a cost. In terms of the level of that cost, again, very uncertain until we get more detail around how the calculation will actually work. We believe it will be towards the low end of this range that's in there, maybe something like £1 a megawatt hour as a rate when it comes in, but we don't really know on that yet. And we are still awaiting more information like everybody else on that cost.
Okay. Thank you for this overview, David. So what are the main costs people should keep an eye on as we go through the year?
Yeah, so I think as normal, CFD and Bacillus are the most volatile costs. So from a CFD perspective, that will move around as wholesale prices move around. There's also new generators that will start. So some big offshore wind farms like Dogger Bank A and Sophia could start their CFDs, plus lots of solar capacity coming onto the scheme. So that's all built into our forecast that will happen. But any changes to start dates around that, any delays to those generators coming online, and then any increases or further decreases in wholesale power prices could drive a different rate outturning. So that's definitely one to keep an eye on. Bacillus, as I mentioned, kind of that link between transmission constraints and whether that drives higher costs in the short term and a need for NESO to increase the rate a bit further ahead as we head towards the winter is one to keep an eye on. We don't expect that to happen as things stand, but there is a possibility. And then, as I say, definitely looking out for more clarity on that nuclear RAB scheme and the EII support levy to some extent as well as we get more invoice data. I've seen a question that's come in asking whether the EI support levy for 2024, 2025 has been invoiced. So it comes through in monthly invoices. So we're starting, and they're a year after the supply period. So we've been starting to see the April invoice come through, which is confirming what we thought across some of the numbers that are there. But that will gradually drip in month by month as we get that information come through as well. I think the final one to keep an eye on that flagged is if we get any more insight on Tenuos, but I won't steal Hugh's thunder in talking about some of the detail on that from April 2026.
Okay, so that's a good segue into the biggest topic for this quarter. Hugh, can you talk us through the increases in Tenuos that we're expecting to see from April 2026?
Sure thing, Charlotte. So just a quick intro. I'll try not to repeat too much for those who were on the February call, but for any new joiners on the call, what is Tenuos quickly? It's transmission network use of system charges. And what it pays for is the maintenance and the expansion and reinforcement of the transmission network. So that's all the cables, the pylons, the substations, all of that helps get electricity from A to B across the country. And all users of the transmission network pay towards it. Not equally, as we'll get into in a bit. So what's changed on that front? So as David alluded to briefly there, the NESO, or formerly National Grid, published their latest forecast of Tenuos charges for the April 26 year back at the end of April. And it was a significant increase year on year. So if we look at the sort of top right chart on the slide being presented, you can see a bit of a comparison year on year. So the total allowed revenue that NESO can collect via Tenuos tariffs has gone up by about £1.2 billion year on year. And some of that is paid for by generators, and a very thin slice is paid for by demand users through their locational charges. But the vast majority, the real bulk of that, about £1 billion, is paid for through the demand residual. So this is applied to all users in the country on a national basis on a banded pence per site per day basis. I'll cover that off a little bit in a second. But just to give a very quick, simplistic view of what that means to customers' bills, if you were to take that money, the extra £1 billion, and smear it over national demand as if it was a volumetric pound a megawatt hour charge, you're looking at about a £4.10 a megawatt hour increase in Tenuos costs, which is a very healthy 26% year on year. It's also worth saying that NESO also did provide a forecast last April, a 5-year tariff forecast from April 2025, and it's still a very, not just year on year, but forecast on forecast, it's still a very big increase of about 800 million in the April 26 year, and more and more in future years as well. So just coming back to that sort of banded pence per day system and how users would actually see this on their bill, all sites for continuous charging are sorted into a band dependent on their voltage level, and then sub bands based on their capacity for larger sites or their annual consumption for smaller sites. And you'll pay a pence per site day equivalent to every other site in your sub band. What this means is that if you consume less, if your sites or portfolio consume less on average than other sites in your band, that fixed charge will be comparatively higher for you compared to others. And vice versa, if your sites or portfolio consume more than the sort of average site in that band, you can spread that fixed cost over more units, and it's less onerous. And I guess if you want to check some of the details, you can see the monitor report itself. We have a breakdown of the final April 25 charges and all the sub-bands. And NESO last week hosted a webinar where they went into a bit more detail in all of the changes. If you didn't join that last week, I think it will be available on their website next week, a recording of both the webinar and the Q&A that followed it. So that was the main update, very shocking sort of increases there. As sort of David mentioned, we had a go at forecasting this earlier based on some of the early data that was released just after Christmas. But NESO sort of put some meat on the bones here and given us a bit more of a view of what the revenue and the tariffs will look like. They also went one step further and gave us a light forecast of revenue out to April 2030. And similar trends, similar sort of multiple hundreds of millions, or if not billions of pound increases on previous views. So while this revenue forecast isn't as concrete as a tariff forecast for those later years, it's a very good indication of where continuous tariffs will end up. So it's a useful guide. So if you look at the bottom right chart now, you can sort of see we've included there the forecast for the April 27 year as well. It's another sort of 800 million year on year from the April 26 year. And really, like, what is driving this? So worth noting, from April 2026, we're going to be entering a new price control period where the transmission operators, so it's the two Scottish transmission operators for North and South Scotland, and NGET, the operator for the England-Wales transmission system, submit all of their business plans to Ofgem, detailing what investments, what works they're going to be doing over the next few years and how much money they need to fund those operations, and therefore how much they will collect from customers via continuous tariffs. And this price control, frankly, is going to need a lot of investment to help meet net zero goals, clean power 2030 goals, that sort of thing. It's going to be very expensive to connect a lot of upcoming intermittent generation onto the grid to move electricity from A to B. Lots of things like under the ocean, sort of high voltage direct current cables to relieve bottlenecks in the network. And again, on the demand side, just to increase capacity. If you're going to electrify everything from transport to heat and everything else in between, you really need to spend a lot of money reinforcing the grid. Now, it is worth mentioning as well that although these are quite significant increases, only the Scottish transmission operators' figures within that big year-on-year spend are based on their new price control BOT-free business plans. The England-Wales ones are just based on their current current price control period and uplifted with inflation. So even though these forecasts are quite large increases, they're likely to be an under forecast. And when the England-Wales figures are available, it's likely to result in further increases in allowed revenue and therefore feed into further increases in likely continuous tariffs. I think broadly, currently, I think England-Wales contributes about sort of half onshore continuous costs. So if they increase at a similar rate, you will see, again, very significant sort of probably hundreds of millions of pound increases in allowed revenue in continuous when we get that data. So a lot of uncertainty remains for now, but big clear signals of large increases to come.
Okay, thank you, Hugh. So what are the next steps with setting continuous tariffs?
Sure. So it might be a bit of a repeat from last time. We're waiting sort of on the same decision points, really, but Ofgem, as the regulator, will give its draft decision, or they call it determination, on the business plans from the transmission operators, whether they agree with them, whether they need to be revised at some point in the summer. We're expecting sort of June, July. On the back of that, NESO will issue a formal 5-year tariff forecast for this period by the end of August. Hopefully, we're expecting based on the new price control plans for all 3 transmission operators, not just the Scottish ones. But really, there's going to be some uncertainty hanging around until probably sort of the tail end of the year, when Ofgem will issue its final decision on the new price control framework. And then finally, at the end of January next year, NESO will publish the ex ante sort of final tariffs for the April 26 year. So those are sort of decision points coming up over the remainder of the year and into early next year. And probably one thing, just a little bit of a tangent worth mentioning, as we go into a new price control, so NESO has carried out a rebanding exercise. So all those voltage and subbands that each site goes in and determines your fixed charge, that is going to be reset for the April 26 year. And it's just worth reviewing your sites to make sure you're utilizing your capacity effectively. And if you can make any revisions, try and be rebanded, that sort of thing.
Okay, so one to keep an eye on over the summer then.
Yes.
Moving on to the final topic before the Q&A, then could you talk us through the recent auction outcomes for the capacity market? Maybe we...
I don't think we can hear you, Dan.
Yeah, I think the sound is... We can't hear.
No, still nothing.
Is it worth one of us carrying on for Dan?
Yeah, do you want to keep going? Here, if you
Yeah,
know.
let me have a quick sip of water between topics. So apologies, I wasn't planning to cover Dan's, but hopefully I can give you all a good flavour of the capacity market. So this was the other event that took place early in the year. I think David spoke briefly at the start. We had capacity auctions took place in March. This was the T-1 auction for delivery in the 25-26 year, which begins in October, ends in September, and the T-4 auction, which begins in October 28 for delivery until September 29. Now, just a bit of an overview of those auctions, starting with the T-1 auction, which is more relevant for sort of customers' bills and budgeting in the short term. That cleared at £20 a kilowatt. Relatively low compared to recent years, which are sort of more in the sort of £35 to £65 a kilowatt range. But it did procure a record amount of capacity, about 7.9 gigawatts. So taking that together, given that these T-1 auctions are nominal prices, they're not indexed with inflation, that adds about £159 million to customer bills to pay for the scheme costs. And if you look at the bottom left-hand chart there, you can see a little bit of a comparison with previous few T-1 auctions. So it's actually quite a bit lower. And although that record capacity, so that's the recent T-1 is the purple shaded area there, it's quite high because of that big reduction in the clearing price. You actually get a lower pound total added to customer bills compared to sort of like some of them being sort of in the 300 million plus range in the past 3 years. So a bit of good news there for customers and a bit of certainty now that that key uncertainty for the coming year has been locked down. However, one thing to mention is, although the T-1 cleared quite low, if you look on the right-hand chart and look at how the overall capacity market charge is changing year on year, we are expecting a year-on-year increase from the April 24 year to the April 25 year. And that's mainly because of the T-4 auction for delivering April 25, which took place 4 years ago. And that has been a trend in recent years for T-4 auctions, that the one is during the T-4 auctions, you procure the vast majority of your capacity. So sort of normally in the range of 40 gigawatts plus. And for years and years now, as existing generation has closed down, so think of all the coal stations, there are no more coal stations in the UK. Some of the old gas and even nuclear stations, as this existing capacity closes down, and existing capacity is far cheaper to support and keep online than new build capacity, it has been replaced by either refurbishing or new build capacity in these auctions, which pushes up the clearing price. And that's been an increasing theme over the past few years. Indeed, I think this T-4 auction that just took place in March for April 2028 delivery cleared at £60 a kilowatt. The third year in a row that it's cleared at or above £60 a kilowatt and procured, again, 43 gigawatts of capacity. So adjusting that roughly for inflation, it's still a bit of a forecast. You're adding about sort of £3.5 billion to customer bills in the 2028-29 delivery year. So it's becoming a more and more significant cost. Like, if again, looking at the bottom right-hand chart, as the capacity market was initially brought in, it was quite a small component of customer bills. It's grown and grown, just reflecting the need that as you electrify additional sectors of the economy, like transport and heat, you have potentially much higher peak demand to meet. You need more capacity to secure peak demand, and an increasing share of that capacity is from more expensive new build sources. So that is a quick whistle-stop tour of everything I know about capacity market. I don't know, David, if you knew Dan was going to talk about any other aspects of the auctions.
Dan is back as well. I mean, one bit I'd add, and then we'll see whether we can hear him. But one bit I'd add is just to stress that point of that rate of increase that we're just starting to see. So looking ahead to this winter, roughly a 50% increase on what we saw last winter for the capacity market charge. And then the following year after that, so the winter of 2026, almost doubling again. So huge increases coming through. But that is only charged between 4 and 7 p.m. on November to February working days. So for customers that consume lots of electricity during that time, it's one to definitely be aware of. But it does also present a potential opportunity to avoid some of the costs, because if you can shift demand from those periods, you're helping out the wider system by not creating demand at very peak times in winter evenings. And there's essentially reward for that by not having to pay that cost. So that is definitely one for people to consider for any future plans over the next few years, because of the ramp up in that cost.
Hi, sorry, I don't know if you can hear me now.
Yeah, we can now.
Okay, sorry about that. I do not know what happened, but
right.
Yeah, it sounds like I think you've covered everything I was going to say. So thank you very much, Hugh. Hopefully, I'll be available for questions at the end.
No worries.
Thank you, gentlemen. That's great. That brings us to the end of the prepared content. So we have now some time for questions that you can put into the Q&A function. And we've had a couple of questions coming in already. So I'll start with this. So is there any update to the new EII and RAB costs? I don't know who wants to take this one.
I think possibly someone who joined late and missed David's intro where we covered this, but I could echo it again. So EII support levy, so as David mentioned, it's this cost is to provide support for energy intensive industries, EIIs, for part of their network charges, which are deemed to be more onerous than their sort of mainland European peers and avoid carbon leakage. So this scheme gives them 60% compensation for their actual outturn BSUOS, JUOS, and GNOS charges. It takes a while to find out what those actual charges are. So hence why the cost is settled so far in arrears. Again, as David mentioned earlier, we're just starting to get the April 2024 outturn now, and that's again invoiced to suppliers and is broadly in the range of what we've been expecting. So roughly in that sort of 70 pence to sort of £1 a megawatt hour range. We have only had the, again, sort of some summer data come through. Network charges tend to be higher in winter, particularly GNOS and some of the JUOS charges, which are modelled on peak demand. And just worth saying that on EIIs, it took a while to really, as a very new scheme, get clarity to include that in our sort of pass-through reference rates, but that should be coming through now, again, for customer reconciliations. Although it has been enough sort of fixed tariffs like peace of mind for a lot longer. So hopefully a bit more confidence on that front. But it's one we're going to keep an eye out as it evolves, like do more energy intensive industries gain awareness of this compensation scheme and join it and increase the costs of the scheme. And as network charges evolve year on year, this compensation scheme will increase proportionally with that. So one we're keeping an eye out. Not too much new news for now. I think the other one they mentioned was the nuclear RAB scheme. So again, regulated asset base. This will pay for new build nuclear power stations. We don't know much about it yet. As David mentioned it earlier, I think the last comms we got were that a decision was expected on the first one, Sizewell C, this spring. And it's probably worth noting now that we are literally, as of today, 1 month away from the summer solstice. So will we get a decision in the next month? Hard to say. People who this isn't their first rodeo will know that often these decisions can get delayed, but we may be surprised. So one, we're, like the rest of industry, constantly on the lookout for more information, because it may be relatively quick that suppliers get levied once that scheme has been announced. It may be as little as 30 days notice. And on the range of that scheme, I think, again, David sort of said at the beginning, could be anywhere between sort of £0 to £4 a megawatt hour. Depends on if and when that final investment decision is made for Sizewell C. But £1 a megawatt hour-ish is not a bad sort of guess for now.
There's been one follow-up question as well around that, saying, do we think that the RAB will be included in the network charging compensation scheme or discounted on billing for companies eligible for EII bills? I think I'm right in saying, Dan, that the chargeable demand for the RAB scheme will be the same as the CFD scheme, which means that energy-intensive industries will be exempt from that charge.
Yep, that's correct. I think we had, I think LCCC had a supplier event last year and confirmed that as the approach they're planning to take for it. Yep.
Yeah. So it won't need to feed into any of the other the compensation mechanisms, anything like that. It will just mean that the rate is slightly higher for everyone else, because the demand of energy-intensive industries won't be included there to divide the pounds billion cost by.
Okay. So next, what are the short-term changes in the CFD and with CFDs negatively impacting liquidity of future seasons? What can be done to undo this?
Yeah, so I'll take that one. I'll deal with the short-term bit first and then come on to the liquidity challenges. So in the short term, one of the big things we've seen is big wind farm NNG, Net Ngueha, which, apologies if I've got that pronunciation wrong. My Gaelic is not the best. That has gone live recently. So that has pushed up CFD payments a bit. It's an allocation round 1 wind farm, which means it has a higher strike price, because the earlier rounds generally needed a bigger subsidy to get built and go live. So where that's come through and is a pretty big offshore wind farm, that is being topped up now and has started in the last month or so on the CFD scheme. So that's pushed up costs a little bit, but that was within our forecast already. So there's nothing new there or a shock to the numbers, but interesting to note. We've also got over the next year or so quite a lot of generators starting, some smaller and some bigger. So lots of the solar generators that are coming through will come through, but they are quite small capacities. They have relatively low load factors as well, and their strike prices are pretty close to market prices at the moment, so they won't add a huge amount of cost as they go live, we expect. You've then also got some more big offshore wind farms coming through, this time from allocation round 3. So I think I mentioned earlier Dogger Bank A and Sophia as two particularly large to highlight. Again, their strike prices are pretty close to market prices, so we don't expect a huge cost impact to come through. And if we were to see a rise in wholesale prices and they start their CFD, then you could actually see them paying into the scheme and net reducing the cost a bit. But will remains to be seen exactly when they'll go live and what the market price dynamics will be as well. On the second question for liquidity, so big challenge that's caused by CFD and growing CFD volumes coming through is that the generators are incentivized to not sell forward their power. So because particularly if you think of onshore and offshore wind farms, their strike price is indexed as it's a market reference price plus a top up, but that market reference price is the day ahead price. So if they want revenue certainty, they need to sell their output at the day ahead stage, and then they will be topped up to their strike price from that day ahead price. If they chose to sell their output earlier, they could get more revenue, but they also risk getting less revenue because the top up will still be against that day ahead price. From a supply side, that creates a challenge that you've got fewer generators looking to sell forward as more generation moves to come from the CFD scheme. And that makes it harder to find liquidity in the market if you're looking to buy power because there are fewer people selling it on the forward markets. In terms of mitigations to that, things like corporate PPAs can be an option for individual buyers, which is essentially a way to get hold of some of that generation for yourselves rather than going onto the open market. So that can be an option to get there. Also, things like on-site generation yourselves can decrease how much you need to buy forward because it's reducing your net consumption, so saving costs at the same time. And things like batteries or other flex can then help manage some of the shape around that, depending on what that on-site generation is, if it's solar panels or wind power or something else. And then I guess one other point to note is the CFD. So we talk about it varying with wholesale prices a lot. It does act as a bit of an offset to wholesale prices. So yes, you might not be able to as easily or for as good a price buy forward power if there's less liquidity in the market. But also, if you're exposed to some of those power movements, you're also exposed to the CFD price moving around that should be in the opposite direction. So there's a partial offset that comes through from that as well. But yeah, I think those are probably the main ways we know of at the moment that can help. It's probably just worth finishing with saying, we act in a competitive market. So if there is a demand that comes through for services to help with that, then suppliers like ourselves will look to find solutions and help people and manage those risks. It can come at a cost, but we're here to sort of help manage those risks for customers.
I don't know if it's worth just quickly adding as well. You mentioned, David, about the intermittent CFD generators having a day ahead market reference price. For the baseload generators, theirs is a slightly different one. They're linked to season ahead market reference prices. So you would expect those generators to hedge at the season ahead, but that still presents the same kind of liquidity challenges as you talked about beyond that season ahead as well.
Okay, thank you. So next, will supplier failures mean that renewable obligation mutualization could happen again?
Yeah, I can take this one. So yeah, so I think there was something in the news recently. Rebel Energy ceased trading in April this year. So it's fairly low impact. So they supplied around 80,000 domestic customers and about 10,000 non-domestic customers. So this will leave behind an RO shortfall, which we expect to be a few £1 million, probably under £10 million or so, but we don't know exactly. But the RO mutualization floor for 24-25 is around £80 million. So therefore, we don't think that Rebel Energy on its own will trigger mutualization. So to add to that, the mutualization floor historically was set at about £15 million until about 2001, when Ofgem changed the rules. So the floor was set to 1% of the scheme costs. So today that's more like £80 million. So that's increasing the threshold for mutualization from 15 million up to 80 million. In addition to that, Ofgem also introduced ring fencing of the renewable obligation certificates since around 2003 or 2023, I think. So this also limits the risk of mutualization because cash is made available throughout the year to pay for the RO, and means any issues with suppliers paying their obligation is flagged to Ofgem earlier, and that impact can potentially be mitigated. So I think the combination of the increase to the mutualization floor and the ring fencing of funds means now or today we think it's much less likely to happen. It's obviously it still could happen, but less likely to happen when it did in the past. And we don't currently expect it to happen at this point. With just Rebel Energy on its own, it would need a lot more failures or a much bigger supplier to get into trouble. I see there was another question submitted before the webinar on the future of RO and FIT schemes over the next 10 years or so, perhaps. So perhaps it's worth me just touching on that quickly. So both of those schemes have been closed to new entrants for a number of years now, meaning the RO and FIT supplier costs have been relatively stable year on year, but there is some movement year on year with obligation levels changing about, the FIT generation or demand changing, but on the whole, they're kind of relatively minor movements year on year. For renewable obligation, these projects have 20-year agreements, except for the early projects that started before 2008. For those projects, their agreements end in March 2027, but all other generators have 20-year agreements after that point. So that essentially means from April 27 onwards, we will see a lot of capacity suddenly drop off. And as such, we expect quite a big drop in the supplier charge from April 27, potentially up to around £8 per megawatt hour or so from the previous year, where that will depend on obligation level, what obligation level is set. After that point, we expect it to gradually kind of taper off until the scheme comes to an end in the late 2030s. And then similarly for FIT, those generators receive their tariffs for 20 years. And we expect from 2030, those first FIT agreements will come to an end. And then we'll see a gradual decline of the supplier charge rate up until kind of late 2030s, until when that finally finishes.
Yeah, just conscious of time, because I think we're at 45 minutes, but there's quite a few questions that have come in. I might just, some of the ones that are a bit more specific to individual customers, I'm sure we'll take away and try and respond to those separately after this. But I might just quickly try and group some of them up so that we answer them, at least with a brief answer before we close the webinar. It's a question on the BSIWOS rates we were showing, where NESO have a rate of 1569 for the winter, but we're showing a range of 1322 to 1573. The reason for that is it's because it's for the whole year, so the rates are separate for summer and winter. There was a lower summer rate, which I think was 1074, someone might correct me. But when you average out the 1074 for the summer and the 1569 for the winter, you get to our low rate of 1322. There's then a risk that winter rate could still get opened up, we think, if there are high costs that come through. And that's why we have the high rate that's there as well. But the low rate of 1322 is the most likely. Hugh, there's a few questions around the banding updates as well. I don't know if there's a quick answer to this one we take away, but I think some question around how it will work with GEOS and sort of what options there are around the update to some of the banding.
Yeah, it should all be consistent across the board. I think the DNO will let you know if you're going to be rebanded, which will involve redoing your LLF. I'm not sure exactly when that will happen, but I'd expect most sites to not be rebanded. NESO has said, yeah, there are new thresholds for high-low capacity and high-low consumption. So we can share a link, I'm sure, after this, so people can know if there's a possibility they may be rebanded. But it should be done on your last 2 years of data available at the point the rebanding exercise took place.
Great, thanks. And then there's lots of questions on the TNUoS increases, as we expected there might be. I think the gist of it is, will it impact everyone equally or differently? I think the expectation here is the increase will be onto the standing charge items. The standing charges are different for different customers, but they broadly reflect a similar kind of volumetric equivalent increase. So you're only paying more if your total consumption and total site capacity is bigger. It's broadly in proportion to that.
Those are national charges as well, they're not regional.
Yeah. Exactly. And then also questions around whether there'll be regulatory challenges, legal challenges, opening up of contracts, things like that come through from it. I guess key thing to stress there is probably this is a standard industry process. Yes, the numbers are a lot bigger and the increases are a lot bigger, but these price controls are ultimately decided by Ofgem anyway. So in terms of regulatory challenges, you maybe wouldn't expect that. We could see, because of the scale of the increases, there being some challenges. I'd expect particularly from suppliers and consumers that could come through around is this really the right thing for consumers and the size of the increase? But all remains to be seen, and it is all still very draft and initial forecasts. It will become a lot clearer as we go through the year as well. And in terms of fixed price contracts and what's there, I think the key thing to stress is to be aware of this. Different people might have different views across the industry. Some people might not be building in the costs. Our role here and what we're trying to stress is that we believe this really is coming. NESO have said there's a big increase of coming. So make sure that any fixed contracts that are being signed, you're not at risk of that ultimately being increased from it not being built in. I think that has very quickly covered off the remaining 10 or so questions that are in there. Sorry, Charlotte.
No, it's good. So, well, I think that it's the end of today's session. I would like to thank you all for your questions, and thank you to our presenters for sharing their insights today. If you want to take a look at our program of webinars across the year, they're there to keep you informed on the latest power market and non-energy cost updates. You can register to attend any of these by heading over to edfenergy.com/largebusiness and clicking on the Talk Power events page. And before we go, we'd love to hear your feedback to help us continue to deliver the right content for you. So if you could give us a minute of your time and click the link in the Q&A chat function to complete a quick survey, we would really appreciate it. And finally, if we did not answer any of your questions today, please feel free to get in touch, and our details are on the screen now. So you can email us at letstalkpower@edfenergy.com, and you can also stay in touch with us by following us on our dedicated EDF Business Solutions LinkedIn page. And that's it. So thanks again for joining us today, and we'll see you next quarter.
Thanks, everyone.
Yeah, thanks, Charlotte.
Thank you very much.
Thank you, everyone. Bye.